What is up? Welcome back to How to Invest in Commercial Real Estate. I'm pumped.
Yes, sir.
It's not hump day. It's Thursday. We really need to film these on hump day. I like saying that. We could be like, hump day.
I can tell you are done with your coffee over there.
Dude, 4 shots. Okay.
Wow. Braden just wants to say hump day a lot.
Hump day.
Hump day. Anyway, what is up?
Well, market turmoils and
Yeah.
tariffs and uncertainty.
Trillions of dollars.
Not my crypto account.
Only thing that's not
up.
Sure. Not up.
Yeah. Now it's time to buy. When Joel's not excited about crypto, that's how you know there's an opportunity.
Yes.
When Joel starts talking about crypto, you should sell it all.
He's not
Yes.
saying it's going to go up, so now's the time to buy. When he
Yes.
says it's going to go up, don't buy. He's done it
if I'm buying, don't buy.
Yes.
If I'm whining about it, buy.
buy.
Yeah. So obviously everyone's kind of fleeing the uncertainty and the volatility in the market, kind of fleeing towards safety. So
Hey, how much of my distribution's been affected by this all this tariff talk, Braden?
None. We're trending up.
In fact, I got more distributions this quarter than I ever have.
Yep.
And so that's what we love about commercial real estate. It is really, really steady, especially if you can get to the point where you own 20, 30, 40 assets, or you're invested in 10, 20 assets. You may have one or two that struggle here and there, but generally it's going to be steady income, steady value creation.
Yeah, that's the beauty about compounding growth. You know, once you get up, like think about how many millions and millions of dollars in revenue we have. Just one center we have, like the Slidell Center, that's $1 million in revenue right there. We've got 23, 24 assets. So when you start to control that much revenue, you put a 2 or 3% annual growth factor. And what we're going to get into today is the possibility that 2-3% is actually a lot more. You put that on tens of millions of dollars of revenue, it adds up pretty quick, you know?
Well, what updates do we have before we get into the topic?
Yes. So we're hard on our earnest money non-refundable on the Richmond, Virginia deal that just got launched out. We are raising equity for that. We've got $1 million, big round number, left in the deal. So we're actively raising over the next week. We're going to try to get that filled up. We are probably closing in 40, 45 days, middle of May, I would say, like May 15th. If I were to just it's probably not going to happen, but May 15th is probably the date.
Enough.
It's probably not, but it probably is. May 15th.
Okay.
After that, we are in contract on a couple assets in Amarillo and one in Victoria, Texas. Excited about those. We went and toured those. Anyway, going through testing those, refining the DD budget, big value lift on the retail center.
Yeah, a lot of heavy lifting, both from a CapEx standpoint, but also a lease and tenant upgrade standpoint.
We haven't launched that one yet, right? That's more like a June.
Yeah, June, July deal.
Yeah. Mm-hmm.
We closed on Landon Square in Cincinnati. That one took forever. We had a lender on the West Coast. We had a seller
In Israel.
We were here. Loan broker, I don't think, was in our time zone. So an interesting one to put together, a loan assumption as well. But I think our blended rate on that deal is like 5.8. So the assumption worked out really great. Definitely be on the lookout for those opportunities. I saw a deal today with an amazing, I think it was a deal you sent me. There was a loan assumption where you could get it at like 5.8, 5.7. I am quoting fixed debt right now, and like 6.8, 6.75 is kind of the going rate. So, I mean, if you can pick something up and assume it at 5.7, that's a massive opportunity.
I think the one
there.
I sent you was big deal, and they wanted like 16 million or so, and the debt was like 10, 11. So it did make it a little harder on the equity side. But
Landon, they gave us a B note to kind of step that basis up, give us our leverage.
And maybe we can look at doing that on that deal.
Yep.
Okay, guys. So, we talk about this, our distributions, they're steady, and, we're getting the 8% cash on cash return. And that's why we're in real estate, is the consistency of the cash flow, the distributions, and the increase in value over time. But today's show isn't about that, because that is boring.
Yeah. That's right.
Today's show is about hitting grand slams in commercial real estate.
Yeah, that's
this idea that every once in a while you find a hidden value that explodes your returns. And I just want to talk about a couple of our experiences, because when I was getting into this business, I didn't know that some of the things we're going to talk about today were even possible. And so I was limiting myself and how I viewed deals. And so we just want to say, hey, a grand slam is out there waiting for you. If you're playing the game, eventually you're going to hit one.
Yeah, I mean, just think about the environment we're in right now over the past 4 years, like crazy inflation and now crazy tariffs, then like inflation's way less of an issue now. We're talking about recession and how much money is being wiped out of the market. So nobody can really predict these things. We're doing our best in our analysis and our underwriting, but at the end of the day, like nobody's going to compound 10% annual rent growth for a decade. And we've been seeing that, right? So the values that you can see compounding are just nuts, right? And it's hard to underwrite. Nobody's going to.
No, you're not. We're going to underwrite
that.
Consistency. We're going to underwrite normalcy, and we're just not going to underwrite the grand slams. But we're going to talk about a few of them today. So, what's the first one we got, Brian?
The first one was a deal that I got in with you. I don't know how many years ago, but it's in Cincinnati.
Yeah, so I'll talk high level, not get too specific, but yeah. So we've had this deal for 8 years now.
8, yeah.
50,000 square feet. And we have a worst case scenario happening right now where one of the tenants is
2 tenants.
Yeah, one of the tenants is closing because of bankruptcy, and the other tenant is not renewing because they moved down the road.
That's a bad day.
And so you're talking about 100% vacant.
Tell me why the one is moving down the road. Why are they moving down the road? Need more space?
I don't actually know. He didn't actually tell me.
He just did it?
They just did it and just said they're not renewing.
Not renewing,
Yeah.
okay.
So I don't know if there was a better visibility, better location. We're in a really good location. But here's the thing that's blowing my mind is we're in communication with tenants right now, and I'm not going to give names because we're not fully signed yet. But we're going to have to give a lot of TI, tenant improvement dollars, to these tenants. But they say with the right TI number, we could get as high as $25, $30 a foot in rent.
Okay.
And
how's that compare to what?
When I bought it, we were at $9, $10 a foot.
Wow.
And in actuality, my mind for this location, I was like, okay, I hope we can backfill it at $9 or $10 a foot just to keep the value.
Yeah.
Because we've been paying distributions on this deal for 8 years, so the investors are happy. I just want to keep the baseline. But
so in 8 years, you might triple the rent.
I might triple it. Yeah, this year.
Yeah, in like
year.
6 months, he may triple.
And I never thought that I would be having discussions with big
Nobody
time.
ever thought. No, nobody. It was never on the radar. Never on the radar.
Well, that I was having discussions with national credit tenants that I could sell at a totally different cap rate than I bought this deal at.
Okay, so
one of them was already again national credit. You had another one that was local. But it was really just the idea of like, hey, maybe one day we're going to lease this for $25 a foot.
Never had that thought.
Yeah. No way.
And so we'll update this podcast if and when I finalize this deal.
Tell me why the new tenant that you're talking to is willing to pay that much more than what the old tenant was, or did the rates just? I mean, did they increase like that?
Here's a couple of things. First is its location. They want to be here.
Yeah.
Okay.
Next to Home Depot. Home Depot is a huge driver of traffic. They love it.
Okay.
A lot of these retailers literally have a geographic like circle or whatever it is for their trade area where their other stores are. They've mapped out their cannibalization.
And
so like
that's
they've
where they wanna
literally
be.
got a circle on a map.
Yeah.
And when something opens up there, because you guys have to remember, like there's not really vacant big box space around the country. Like even these like bankruptcies are immediately being bought up by private equity and backfilled with another concept. So when something like this happens, it is just like we have to be here. There's no other spot. Nobody's building new stuff.
So a big lot it can be bad sometimes because it's hard to fill, but sometimes it can be good because it's just the right spot for someone who wants it.
Yeah, and here
It's a big space.
the key for the higher rent is that they really want us to fund the store opening. It's not just about TI. I think the number will be really, really huge. Uh-huh. And so they're like, okay, we get all this cash up front and we delay the payments over years.
Okay.
But I don't care because when I sell it, if I'm selling it on a 6.5 cap, I'm getting 15 times that rent number today.
Let's say you bought this property at a 9 cap,
Right.
right?
Yeah.
And so now you think with this tenant in it, you could sell it at 6.5?
6.5.
Wow.
6.5. Yeah.
obviously better credit.
Yeah, way better. So like
just on one side, you've still got an upside potential on the other side.
Yeah, I've got national credit tenants asking me about both the spaces, and so it's just cool to think that I never, as a professional in the business, never had even allowed myself to think that this was possible. So that's got me thinking, like, what else am I not thinking as possible and not taking advantage of? Am I challenging myself enough to say, hey, I'm raising this person, 3% a year in rent. Is that all I can get? Am I sure I've exhausted all the tenants available to me? Yeah. And so we all need to be challenging ourselves all the time, because our reality and what we think is possible is only self-limiting. It has nothing to do with what is actually true in reality. But we tend to limit ourselves based on what we can conceive.
Before we move on to the next one, have you put numbers down on what you bought it for and what it could at 9 cap and what it could be worth at a 6.5 cap with the new rent? And
yes.
The new ROI,
we could maybe sell it for triple
what you paid for it. Wow.
But remember, that's not tripling our money, because number one, we barely have any money left in the deal, but we got an 80% loan. And so we only had 1/5 of that purchase price in the deal in cash.
Gotcha.
So then you got to say, okay, I'm getting 10 times, 11 times my money back.
Wow. Amazing.
Did I do that right?
I'm pissed.
I'm glad I invested in that one.
Yeah. Why am I not in that deal?
I'm going to go see how much I put.
There actually isn't very many investors in this deal, so that'll be really good. All right. That's just one example, but we got a couple that are even better. Let's go.
We're going to have this phenomenon of like everyone pitching us deals. Yeah, it's steady. And then, we just doubled the rent in year 6. I don't know how it's going to happen, but we just doubled the rent.
Yeah, we smoked a bong and then we decided that we could do it.
All right. Okay. Next one's in Wichita, our deal in Wichita.
Yeah, this is kind of a double whammy because it had both opportunities. Right now in the marketplace, we're looking for maybe stabilized deals that have an out parcel that's worth additional or more value than the center behind it, and you can separate off the out parcel for a higher value, sell that down, and then your basis in the remaining shopping center is really good. So we love opportunities like that, and then we also love the opportunity of kind of a stabilized looking deal, and it's just got super cheap rents. So the probability of people leaving is slim to none, because across the street, around town, rents are double whatever they are. So it's easy for us to push rents. Yeah. This was kind of a combination of both of those. So we executed the out parcel sales, massive win, massive success.
I don't want to skip over that, so I'm just going to give a couple of ideas on that.
Yeah.
Because these are grand slams, guys. Like when I started, if you would have told me, hey, Joel, you can buy a commercial real estate deal, and within a year, you can have zero money in that deal and make infinite cash indefinitely for years to come, I would be like, that doesn't make any sense. Infinite returns, no money invested. How is that even possible? Like, nobody talks about that. And so that's what we did with this, is we didn't sell one out parcel.
Yeah.
We sold 3, and we didn't have to conceive of that. They were already there. It's not like someone said, "Oh, I'll put a building here." No, there's 3 buildings already there.
They were already replatted.
And the people we bought it from were real estate professionals.
So they said,
yeah. So they said, and so they had this little gold mine sitting right in their lap the whole time, and they never took advantage of it. And here, 3 idiots from Oklahoma come along, and we'll just sell those out parcels at a drastically lower cap rate, and then we're going to get 100% of our investment back to our investors. They'll be in no money down, infinite returns from here on out. But then it didn't stop there, because we have this center with these super low rents and some vacancy, and so now we're even seeing a double hit. Go ahead.
Yeah, we had maybe 10, 15,000 square feet of vacant space that we were just trying to lease up. I think we were advertising it for like $7 a foot or something, and then we bought it. There's a, I don't want to say crappy, but there's a lower end furniture store, which tends to be a great filler of space. Yeah. You always find these lower end furniture stores around town. They were paying like $1.50 a foot in rent plus triple nets, so like effectively nothing, right? And we've been able to, right now we have signed LOIs on like 25,000 feet that we're moving to lease. We're negotiating the lease, should be signed anytime. Rent commencement's going to be in Q3. They're basically taking the space as is. The rent's super cheap. We've got great credit on some of the space, and we've got additional LOIs on the rest of the shop space. So I think we'll add hundreds of thousands of dollars to the NOI of that deal this year as well. And again, everyone's already gotten paid back. We already paid down the note a ton. We've already got a couple $1 million of equity sitting there, and we just added a few $100,000 of NOI. So you put that on an 8 cap. Let's just put $250,000 on an 8 cap. So that's another few $1 million in value. So we potentially went from, like, we all put $2 million in. We got that money out. Yep. It's still cash flowing a little bit. We made great cash flow for the first year. We probably had $2 million sitting there, the equivalent of whatever our initial equity contribution was. And now that 2 probably just went to 5.
Yeah, nice.
I mean, just massive home run.
Big check for everybody when we sell it.
Yeah, we'll recapitalize at some point. We'll have enough NOI to where we could leverage up and pay out additional equity if we wanted to. There's not a massive incentive as us to go kind of personally guarantee additional debt when the LPs already have their money out. So, at that point, you just look at ridiculous cash flow or maybe some like non-recourse refinance with a great rate.
I like a life co, lower leverage rate, long-term fixed,
non-recourse, cash flow the crap out of it.
Yeah, so that may be an option there. Normally, we're leveraging up to maximize return, but here the return's already infinite. Nobody has any money in the deal, so keep it safe. All right, we got another one.
Yeah, Slidell.
That's great. That's great. Slidell. Yeah, Slidell is a good one. Right outside of New Orleans, like 20 minutes. And we had a big, again, national tenant go bankrupt. And as we've seen all over the country, just immediately we had interest from other tenants, and we doubled the rent on 25,000 feet right off the bat. We had another tenant that was going dark. They went dark like a year before their lease expired. They're paying us rent every single month, even though their store's closed because they have lease term. And we have a ton of interest on that. Again, double the rent per square foot. And we're talking about going from like 6, 7 to like 13, 14, 15 per square foot on almost 50,000 feet. Like we're going to re-tenant half the damn center. So I know you brought it up. Some of the investors in this deal are going to be like, wait, you guys said you weren't paying out distributions this year. Yeah, because we got to re-tenant this space, right? When you lease 30,000 feet, a lot of times you're writing them, a $500,000 check, $1 million check sometimes to get some of the rents that we were talking about on the first deal. It's worth it because of the value you're getting on the back end. But yeah, short term,
you'll give them free rent to build out the space.
Yep.
So they're going to have a free rent period. And you got the TI, which helps you get double the rent.
Yep.
On the outparcels are taking a long time to parcel off. So
we didn't talk about that one. This one's got the same outparcels. It went in, like we went in with a massive parking lot and a meeting with the mayor where he's like, I need more retail here. So he worked with us to help create these lots. We worked with us to get the place out of the flood zone with the new FEMA maps, and it was kind of a mess. And now we've got 2 out of the 4 of those in contract, ready to close. We've got O'Reilly's on the hook, ready to pay us $1 million for an acre. We've got a Take 5 oil change concept, which is doing a ground lease, which effectively puts that at $1 million for that acre. So again, it went in as this stabilized deal, and that's kind of the thesis in the marketplace, or the perspective I'm looking at in the marketplace right now is when we can find these stabilized looking deals, but we've got the opportunity to hit a home run with an outparcel sale or by significantly going up on the rent, right? I know we're underwriting, a few % annual increase in the NOI. Some of them we're getting a little more aggressive, like this massive value add we're doing on the 2 Amarillo centers and 1 in Victoria. Like we're underwriting some serious rent growth, but when you break it out by tenant and you see the value add we're doing, it's way more believable. And we just executed it in Amarillo, so we feel a bit more confident about it.
So we got one more, then we'll wrap it up. But I was going to talk about apartment deal. Just because we don't talk a lot about multifamily, but multifamily is its own driver of value. And, a grand slam that we hit in multifamily years ago, we purchased, I can actually do a few of these, but we purchased this smaller deal at about $12,000 a door per unit, $12,000 per unit.
Nothing. Pennies.
And we bought it from like a big real estate outfit. Like it wasn't, nobody. It wasn't like a local person. It was a big company, but they were the area had gotten tougher. And they were like, we want out of this area. Well, okay, that's fine. What's happened over the last several years is that area has gotten better. Like they sold it kind of at the worst. It's not, primo area, but it's way better than it used to be. And we renovated the exterior and we renovated the interiors. And now rents have doubled.
Haven't you renovated the exterior twice now? Because you did it when I was there.
Well, we're just doing the interior now. We did the exterior several years ago, interiors now. But that deal will sell for over $100,000 a door. Now, I'm not selling it right now, but when I sell it, and I think we purchased it maybe about 12 years ago.
So 8 times what you paid for it.
Yeah. In 12 years, 8 times.
Is that
nine times, 12,000 a door.
Is that market
8
or
times
THA?
12 is 96.
Yeah, so 8.5. We're right in the middle. I'm gonna sell for 104,000 a door, Brian. 108,000 a door.
Plus tax makes it.
Yeah, the battle of the engineers over here.
But anyway,
nobody cares.
guys. I mean, if anybody would have said, "Hey, Joel, just start buying apartments," and 1 out of every 10 complexes, you might be able to sell it 9-10 times what you bought it for.
10 out of 10 complexes. We could have bought in every apartment complex in town from 2014 to 2020, and we would have been fine now. We would have been fine because the whole freaking city went nuts. Like we were underwriting deals at 50,000 a door, and we're like, "Oh, there's no way we can sell this for 60 after we're done."
I know.
It's just like,
It's really crazy.
They're $100,000 a door apartment complexes, and it's not because the wood got that much more expensive, guys, or the roofing materials got that much more expensive. It's rents.
Yeah,
like
mainly inflation.
Who rents a house or an apartment? That shit got expensive quick, right? That's what drives the value, and that's what we're talking about in retail real estate and these apartments. It's like. You can go in and say, "Hi, I'm the new owner. Your rent's getting more expensive." Like it's almost that simple. It's almost that simple.
So I know
they do the same thing with milk.
Yeah,
like, hey,
eggs.
Eggs, same exact thing. I know they used to be a couple dollars a dozen, but now they're 10.
Yeah,
Sorry,
and you're still going to pay it. Hey, but I hear the voices, and they're saying, "You guys are always talking about the best case scenario." We are, because we believe in this. This has taken my net worth from zero to what it is today over the last 15 years. And we want you guys to believe it can happen for you, because if we only talked about the struggles of real estate and everything that could go wrong, like toilets in the middle of the freaking night, no one's going to get involved. Yeah. Right? So do you want an excuse to pass on what we think is one of the greatest investment opportunities that the country has to offer? Or do you want us to encourage you by telling you about our success stories so that you'll have the faith, you'll have the belief that you can do it, and you'll get in this game and start acquiring assets? Right? That's why we do it. Like, we can talk about, and we have talked about some of the struggles. But
I do buy assets, Joel. I just bought a new car. I just bought a new Rolex. I got assets in my life. It's all about those assets. Look at this.
Yeah. So half of the show is telling you how to buy commercial real estate, but the other half is why to buy commercial real estate, right? We could rename the show "Why to Buy It." How is one thing, but why should you, and why are you going to get excited about doing it? Yeah. And so that's what this show is about, is grand slams every once in a while. If you're playing the game, you're going to hit a grand slam every once in a while. Yeah. So,
everybody's got their thing, right? Like there was all that time we weren't buying all of those apartment complexes that we would have absolutely killed it on.
Oh yeah, people were buying them and they were killing it. We just weren't. We just weren't those guys.
Exactly. So we're kind of doing that same thing, and other people are on the marketplace going like, "Oh man, how does this work? How does this work? I mean, it's the exact same concept. Somebody else is always kind of out there figuring it out, having figured it out. And you always hear about these massive shifts. Well, like since I've been in the workforce, like for a long time, we've just been riding a high. I don't think people have appreciated the fact that we've been on an absolute bull high for just arguably too long. So, I mean, stuff like this, when there's a massive shift, is massive opportunity, and you hear about it all the time. It's hard to capitalize on that opportunity when shit just gets better all the time. It's hard to complain about that in the same sense, because it is getting better at the same time. But now is when there's real opportunity,
especially if we go into a full-blown recession and we see money tighten up. There'll be deals to be had because people will be forced to sell. Okay, well, hopefully you guys are encouraged. Hopefully you get in the game of commercial real estate. Hit us up with questions.
Yeah. Hey, I got this deal I want to buy. I'm just going to double the rent in year 2. We should buy it.
Yeah.
Okay. See you guys next week.